Okay. In your ICI new study material, there have been 4 additions, technically 3 additions. I have made it as 4 different additions. One is they have added an area called credit derivatives, where we have 2 items. One is called credit default swaps, and we have another thing called a CDO, collateralized debt obligation. The CDS notes were already given to you in that earlier book which I gave, but the CDO notes I could not complete by that time, so I've just given an extra material for that. So, and there's something called as an exotic option which ICI has added, and an area called as option Greeks. This was there in old syllabus also, but I was not covering that much in detail because no questions were tested. Now, because of MCQs coming in, a question can come in MCQ. That's why I'm going to discuss also option Greek. First, I'm going to start with an area called as exotic option. I'm going to discuss exotic option, which is page 5 of this new material. Page 5 of this new material. Okay. Nothing for you to see in the material. Be in listen mode. When something needs to be seen, I'll let you know. I expect ICI asking mostly MCQs from this. Mostly MCQs can come from this. Valuation of exotic option may not get tested because that is a very complex area. I have gone through this. ICI material has zero practical problem, zero reference of valuation. Now let me first explain what is exotic option. Exotic options are those which are not the normal option. Normal is, we normally use the word plain vanilla option. That's the term practical world people use, plain vanilla option. That is, what is plain vanilla option? Is a call option or a put option with single exercise price, single maturity date, or single American option, European option, all that is there. Now, what is exotic option is, you will add lot of complexities into this. These are extremely complex option, and most of these are OTC product. What is OTC products? Over the counter product. It will not be traded in the market. I'll customize according to my requirement. I'll give you an example. A call option, let's assume exercise price is 100. The market price can be anything. The market price can turn out to be. So you will calculate your gross payoff on the maturity date. Now let's assume on the maturity date it's 110. On the maturity date it's 110. So I ask you a question. Do you want to buy at 100 when the price in the market is 110? Answer is yes. Now answer is yes. We used to say 110 minus 100 is the final answer. Or 150 minus 100, 120 minus 100. There's an option called binary option. Now what this option says is, if you are going to exercise, pay 1000 rupees or pay 500 rupees, pay 0 rupees, whatever is the amount you decide. If you are not going to exercise, you will get 0. So if the price on the maturity date, exercise is 110, price 111, I'll be paying 500 rupees as the payoff. I'll have to pay 500. That's the fixed payoff. That's the fixed payoff. 112, you're going to exercise, pay 500. 115, you're going to exercise, pay 500. 1000 rupees, again pay 500. 1500 rupees. So whatever happens to the final price, if you are going to exercise it, pay 500. If you are not going to exercise, obviously 0. This is one type of an option called binary option. What is binary option is, there's a fixed payoff. I'm going to give only a fixed amount on the maturity date. In your action, when we do your gross payoff table, or when you do your payoff table, we prepare a payoff table like this. Just give me a minute. We used to prepare a payoff table like this. Market price changing, exercise price is this. You said lapse 00, exercise 1000, 1000, fixed amount. That's all. I'm going to pay a fixed amount. Moment you say exercise, you'll be paying a fixed 1000 rupees. Whatever is the terms of the agreement. Whatever is the terms of the agreement. This is called a binary option. This is called a binary option, where I am going to pay fixed amount, whatever is the decision, whatever is there. Then it's like a bet. You win the bet, I'll have to pay 1000. You lose the bet, I'll pay 0. That's all. You are paying premium on day 0 and you are done with your work. So first type I'm discussing is binary option, also known as digital option. Option guarantees the payoff based on the happening of a specific event. If the event has occurred, the payoff will be pre-decided amount. Event has not occurred, there will be no payoff. It's purely like a bet. I can say it is going to rain today. If it's rain, you have to pay me 1000 rupees. It's not going to rain today. I'll not be paying 1,000. I'm getting a premium and then we are just closing it that way. So that is how this is going to work. So I'll give an example for this now. I don't want you to see the material. I don't see there is any utility in the material. I've given you so that you can refer it later. That's all. So date of purchase of an option is September 8, 2022. These are actual numbers I took for TCS. These are actual numbers taken for TCS. The purchase happened on September 8, 2022. The fixed payoff is 1,000 or 0. The fixed payoff is 1,000 or 0. That's the decision. If you exercise, I'll pay 1,000. If you don't exercise, I will pay 0. No concept of saying that I want to compare what is the exercise price, what is you have to compare for only one thing. Do you want to exercise it or not? You will have to give me just that answer, only that answer. Now one headache can come, what to do for at the money. That depends on the terms of the agreement, because this is a over the counter product. This is a over the counter product, because at the money we normally say lapse, because the payoff used to be 0. At the money is, we used to say lapse. Here it depends on the terms of the agreement, whatever they decide in the terms of the agreement. So this is the price on September 8, 2022. This is the actual price on September 8, 2022. These are real numbers. These are real numbers. The strike price is 3,400. So now you'll have to check. Do you want to buy at 3,400 when the price in the market is 3441.90? Answer is yes, you will get 1,000 rupees. You will get 1,000 rupees, or you will have to pay 1,000 rupees, depending on whether you are a call buyer or call writer. 1,000 rupees will go from one person to the other person. Next question, do you want to sell at 3,400 when the price in the market is 3,441? Answer is no, it will lapse, payoff will be 0. This is a binary option. Binary option is, it is called as all or nothing approach also. It is called all or nothing approach. It is also called as a digital option. It is also called as a digital option, where I will be paying a fixed amount. I'll be paying a fixed amount. Any doubts on binary option? There are some 8-9 options which are there in your material. The first option I've discussed is a binary option. Any doubts? Well, premium is day 0. Whatever premium is not fixed. Premium is on day 0 you'll have to pay, no? The last day payoff is fixed. It's either 1,000 rupees or 0 rupees. What is the premium? You'll have to do valuation. How will you do valuation? It's outside your syllabus. It's outside your syllabus. Valuation, you may have to use Black-Scholes with certain other approaches to do the valuation. So let's not get into all of that now. So basic thing is, exactly how the valuation will be done is 1,000 into what is the probability of it getting exercise, 0 into what is the probability of it not getting exercise, and you discount it to today's value and get the option premium. So let's not get into the option premium part calculation and all. One thing which is very clear is, wherever, for example, we draw this diagram earlier in the 880, 440, you wrote 715, 65, no 715, 1,000, 1,000, 1,000. If it's exercise, 1,000. If it's not exercise, it's 0. So you may try it through binomial model also. Wherever it's exercise, you'll write 1,000. Wherever it's not exercise, you're going to write 0. So that's how it is going to work in binary option. Any doubts in this? So binary option is very simple. I am going to give a fixed amount. Give a fixed amount on the expiry. Payoff is on the expiry. Okay, don't confuse it with the premium. Premium is today's payment. Any doubts in this? Okay, second option I'm going to discuss is basket option. Now, what is basket option is, I have bought 1,000 shares of TCS, 2,000 shares of SBI, 3,000 shares of the Tata Motors. So I have so many shares. Now I want a single option taking care of all this basket of my portfolio. Taking care of my portfolio. Now how I can do? Let's assume all this is today value is 1.5 crores. The value of all this is 1.5 crores. Your portfolio, which comprises of TCS, Infosys, maybe Tata Motors, multiple companies are there, SBI, all these are there. Value is 1.5 crore. Now you don't want this to go below 1.4 crore. You don't want this to go below 1.4 crore. So I go to one person, because it's an over the counter product. I say, can you give me a put option with an exercise price of 1.4 crores? With an exercise price of 1.4 crores. So he will give me a put option with an exercise price of 1.4 crore, where This basket of portfolio, if the value goes below 1.4 crore, I'll exercise it. If it's above 1.4 crore, I'm not going to exercise it. So instead of buying it for one share, you're buying it for a basket of your own portfolio. How premiums are decided, again, it's a very complex process. So let's not get into the premium part. How will it be exercised? How will it not be exercised? It's all the same logic. Call option will get exercised. So I'll ask you a question. Do you want to buy your portfolio, or do you want to buy a portfolio at 1.5 crore when the value in the market is 1.6 crore, or when the value in the market is 1.4? Instead of buying one share, you're going to buy a portfolio of share. Let's see an example. A basket consists of 1000 shares of ICICI Bank, 500 shares of TCS, 250 shares of Infosys, 500 shares of SBI, 2000 shares of Reliance Industries. I entered into this contract on September 8, 2022. Maturity September 8, 2023. On the date I entered my portfolio, whether I had the portfolio or I did not have the portfolio, I'm not bothered about it. The value is 150 lakhs. On the last day, the value is 200 lakh. On the last day, the value is 200 lakh. I took an exercise price of 175 lakh. I took an exercise price of 175 lakh. Now you can understand that the price of one share or one basket is in practical world today 200 lakh. The price is 200 lakh. Your exercise price is 175 lakh. Question is, do you want to buy at 175 lakh when the price in the market is 200 lakh? Do you want to buy at 175 lakh when the price in the market is 200 lakh? If you say yes, it will get exercised, there will be a payoff. If you say no, it will not be exercised, there will not be any payoff. It is like one share only. It is like one share, but we are doing for basket of option. Why basket of shares? Why I am doing this is, I have a portfolio. I don't want to do individual hedging, the delta hedging and all. I'm not interested in doing all this individual hedging. So I sit with someone and say that, can we enter into a contract like this so that I get my portfolio properly hedged? I get my portfolio properly hedged. So if it's 200 lakh, exercise 25 lakhs will be the payout. 25 lakhs will be the payout. If it's 200, put option will lapse. Put option will lapse. Any doubts on basket option? You can understand basket option is for one share. Just understand that it is only for one share rather than understanding that this is for so many share. It is just for one share. What is the current market price of one share? 150 lakhs. What is the price after 1 year? 200 lakhs. What is the exercise price? 175 lakhs. Any doubts on this? Clear? The third type of an option which I'll discuss is chooser option. So what is a chooser option is, I bought the option on day 0. Expiry date is day 365. Somewhere on day 180, I will decide whether I bought a call option or a put option. Chooser option gives you the flexibility. When you buy, you don't know whether it's a call option or a put option. On some specific date, that will be the terms of the agreement, you will decide whether this is a call option or a put option. You will decide whether this is a call option or a put option. For example, today price is 100. Exercise price is 110. Exercise price is 110. On this day it is 120. On this day it is 120. You can decide on this day whether this is a call option or a put option. On day 180, you have the flexibility to decide whether it is a call option or a put option. Answer carefully and tell me. If exercise price is 110, market price is 120, whether call is in the money or put is in the money. One of them is in the money, one of them is out the money. Which is in the money at this day? Call is in the money. I'll choose this to be a call option on the day. I'll choose this to be a call option. On the maturity, it may end at 80. It may become lapse also. On the maturity, it can become lapse. So on day 180 or day 270, it's not going to be day 365. It will be as per the terms of the agreement. You can decide as per the terms of the agreement when do you want to choose. This increases my return potential. Obviously, the premiums are going to be on the higher side. The premiums are going to be on the higher side, because what this does is, price today is 100. If it goes up also, I'm happy. If it goes down also, I'm happy, because I can decide whether it is a call option or a put option. After day 180, I'll have to ensure that it moves in the way I want it. because after day 180, if it's not moving in the way I want, it can be a trouble. But on day 180, I can decide whether it is a call option or a put option. This option provides a right to the buyer after a specified period of time to decide whether the purchased option is a call option or a put option. Moment you decide this, it is like a plain vanilla option. After that, you have decided that it is a call option. What will be the payoff? If you exercise it, difference. If you don't exercise it, no payoff. After that, it becomes like a plain vanilla option. Any doubts on this? You can decide on day 180, day 270, day 90, depends on the terms of the agreement. Let's see an example. Date of purchase September 8, 2022. I will decide on May 31, 2023. All these are real data. Okay. On May 31, I'm going to decide. Expiry is September 8, 2023. When I entered, it was 3169. On May 31, it was 3289. You will not know this on that day. Okay. Your price is 3400. Your price is 3400. That's the exercise price is 3400. On this day, you will have to decide. On this day, you will have to decide whether you want to take this as a call option or a put option. Whatever decision you take on that day, it will then ultimately happen, or ultimately you will be able to tell whether you're exercising it or not. Tell me what decision you will take on May 31, 2023. Call option or put option on May 31, 2023. Put option. So I took this decision. Ultimately, it got lapsed. Because the price went up in the market. Ultimately, it got lapsed. That's not in your hand. Ultimately, what is going to happen is not in your hand. Decision you have to take. What decision you will take? Whichever is in the money. That's the decision I'm going to take. Whichever is in the money, that's the decision I'm going to take. Clear? Any doubts on this? So it gives me a flexibility. To decide whether it is a call option or a put option. Not on the last day, somewhere in between, or whatever is the terms of the agreement. Any doubts on this? Obviously, premium is day zero. I'm not getting into valuation. Please don't keep asking me on the premium part. Premium, I'm not getting into now. Premium valuation is not, it's a very complex area. If I get into valuation, that itself can go for some 20 hours of discussion. So let's not get into valuation. It's not there in your ICA material. There's zero problem, zero reference of valuation. In fact, ICA material says it is very difficult to value these type of option. That's the exact word used. It's a very complex kind of an option, difficult to value. So don't ask me on the premium. I'm just telling you what is going to happen on the maturity date. One thing I can tell you is chooser option premium will be more than a normal option. Why it's more? Because it gives you more flexibility. Any doubts on this? Everything is over the counter. Depends, whatever is your terms. Whatever, you'll have to pay and you'll have to put option is selling the share. So if you exercise it, you will, normally it's net settlement. That's what will happen. But whatever is the terms of the agreement, over the counter only. There is no trading happening on these products. Any doubts on this? Because it is, somebody will say May 31, somebody will say no, I don't want May 31. Can you give me April 30 date? Somebody may say, can you give me a June 30 date? So it depends on the terms of the agreement. Next is barrier option. Now, what is barrier option is? It is like a normal option, but this option will get activated only if something happens. Now, let's understand this. Day 0, day 100. Price today is 100. There's a barrier limit called 150. Let's assume 150 is the barrier limit. If price is just moving here and here, this option is not even activated. Activated means it does not even become a live option. That is, there is a barrier, there's a limit which is set in. Once you touch that limit, then only you can tell me whether you want to exercise it or not. So let's assume today is 100. The exercise price is 110. Let's take it as a call option only. call option. Today it is 100, exercise price is 110. But only thing is I have put a barrier saying if it touches 150, it becomes a live option. So assuming on the maturity date it closes at 130, it closes 130. I'm not going to ask you a question, do you want to buy at 110 when the price is 130, because it is not even a live option. It has not touched the barrier. Moment it touches this barrier and it comes down, I have no problem, but it has to touch that barrier. It has to touch that limit which is set in. Moment it has touched the limit, then only an option becomes a live option. Then you can check whether you want to exercise or you don't want to exercise. So let's assume this is the spot price, this is the exercise price, and this is the barrier limit. If you are in between this and on the day, on the last day, you're above exercise price, still it will not get exercise, still it will not get exercise. It is going above, on the maturity it is below, it will not get exercise, because call option by nature will not get exercise if on the last day the price is lower than the spot price. I'm discussing call. Put is the opposite of this. It reaches this limit and remains above the exercise price, then only a payoff will happen. Then only a payoff will happen. First, it has to touch the barrier. It has to touch the barrier. Moment the barrier is touched, it becomes a live option. Barrier is not touched, it does not become a live option. The barrier can be different for a call option. The barrier can be different for a put option. All this is terms of the agreement. All this, the premiums for this will be lower than the normal premium. Why will it be lower? Because you have set a barrier limit. If the barrier limit is not touched, this option does not even become a live option. This does not become a live option. So it will obviously have a lower premium. It's going to have a lower premium. Let's see an example. Date of purchase September 8, 2022. Let's not focus too much on the numbers, because if you keep focusing on the number, you're not getting the crux of it. Barrier price for call option is 3,600. Barrier price for put option is 3,000. If these two limits are reached, the option will become live. If these two limits are not reached, for call option you have to reach 3,600. For put option you have to reach 3,000. Actual price, maximum price in that 1 year. These are actual maximum price in that year. This is actual minimum price in that year. Unfortunately, barrier is not passed for the call option. Barrier is not touched for the call option. I am not going to ask, do you want to buy? Do you want to buy at this price? All that does not come into picture, because you have not touched the barrier limit. Put option barrier is touched. Put option barrier is touched. So you can ask the question, do you want to sell at this price when the price in the market is so much? All that you can ask. So status of barrier, option did not get activated. Option did not get activated. Price did not touch the barrier price of 3,600. So I cannot ask you a question, do you want to buy at 3,400 when the price in the market is 3,441? You will say yes, but that question itself does not come. That question itself does not come. Hence, option will lapse on maturity date, irrespective of option being in the money on maturity date. It is in the money, in fact. It is in the money, but it is barrier is not touched. Option will not. The premiums will be on the lower side. The premiums are going to be on the lower side. Put option barrier got activated. Barrier got activated, but unfortunately it is lapsing, because do you want to sell at 3,400 when the price in the market is 3,441? You said no. Do you want to sell? Answer is going to be no. Any doubts on this? I'll wait for a minute. Just go through these four type of options. I've discussed binary, I've discussed barrier, I've discussed chooser option and basket option. I'll wait for a minute. Just register these four. Let me know if you have doubts. See with the example, you will understand it better. don't ask me anything on the premium part because that is valuation of an option which is kind of not there. You see different type, are you understanding it or not? That's why examples are there. Okay, I'll proceed now. I have another four categories, which are totally eight categories are there. I do see MCQs coming from this area. I at least expect ICI should test some MCQ from this area. I'll move to the next type, which is called spread option. Any doubts on the four options which we have seen? Any doubts you have anywhere, let me know. Only thing you need to be very clear is when is it going to be exercise, when is it not going to be exercise. That clarity alone is needed. So barrier option has a different way of doing it. Your chooser option has a different way of doing it. Your basket option has a different way of doing it. So that clarity alone needs to be there. Now what a spread option is? Spread is basically difference in value between two underlying assets. For example, Nifty and Sensex, I want to find the difference. Or I want to find the difference between ICICI Bank and SBI Bank. I have given an example. I'll come to that example. So in spread option, I have taken an example of TCS was at 3169, ICICI was at 898. Can you tell me the difference between these two? Difference between these two. 22. Okay, 2270. So basically in a spread option, what I'm trying to say is I am thinking whether the spread will increase or spread will go down. That is the gap between TCS and ICICI. These are not two related companies, but still I wanted to buy a spread option like this. So in spread option, we are saying, is this gap going to increase or is this gap going to decrease? How can the gap change? TCS goes up, ICICI goes down, the gap will increase. TCS goes up, ICICI also goes up, but TCS goes up at a higher rate, ICICI goes up at a slightly lower rate, the gap will widen. TCS falls, ICICI falls but at a higher rate, ICICI falls at a higher rate. So you are trying to find the gap between the two. So what you need to do is on the last day, see what is the gap. So it is like now this, your exercise price is 2300. The actual market price is 2471. Just understand the actual market price is 2471. Do you want to buy at 2300 when the price in the market is 2471? If you say yes, call option will get exercise. If you say no, call option will get lapse. Basically, we are looking at the difference between two underlying assets which could be related, which could be not related. Gold and silver, I want to check the difference between them. I want to check the difference between gold and silver. Underlying asset is gold is 10 grams of gold and silver I want to take 1 kg of silver and want to compare the difference. Or I want to compare 1 share of TCS and 4 share of ICICI. Your wish, whatever way you want to do it. But whatever is the terms of the agreement, you're going to find the gap. You're going to find the gap, the spread. If the spread has widened, call option may get exercise. If the spread shrinks, put option may get exercise. The put option may get exercise. There is always going to be a strike price for this. There is going to be a strike price. I am doing this. I'm thinking market is going to crash. I'm okay market crashing, but only thing I want to know is can ICICI crash more and TCS crash less? If that happens, the gap will widen. Or if it's going to go up, basically if TCS is more stronger than ICICI, the gap will keep widening. The gap will keep widening, whether it falls or whether it goes up. The gap can keep widening depending on which is stronger. So I am taking a bet not on the market direction. I'm taking a bet saying that TCS is going to perform excellent as compared to maybe ICICI or TCS and Infosys, which could be a good combination. I want to do the spread between TCS and Infosys, whatever the spread you want to do. Any doubts on this? So this type of an option is called spread option. Okay, next is called Bermuda option. This is somewhere in between. There's something called as an American option. There's something called as an European option. When can American option be exercised? Anytime. European option, end up. What is Bermuda option is they will say you can exercise this on 3 different dates, 4 different dates, 10 different dates, 15 different dates. The dates will be decided. For example, 1 year option. On Jan 31 you can exercise. On Feb 28 you can exercise. March 31, April 30. Last day of every month you can exercise if you want. The terms can also say that if you have exercised on Jan 31, contract is over, or it can say Jan 31 you can exercise, again you can exercise on Feb 28, again you can exercise on March 31, again you can exercise on April 30. These are over the counter product. You can decide what you want to do. Multiple times exercise is also possible. American option, only one time exercise. American option, if you have exercise, contract is over. European option also one time, but on the last day. Bermuda option depends on the terms. Depends on the terms. It's in between. It's in between the American option and European option. It is in between this, where some specific dates are there. Example, again these are live data. September 8, 2022, September 8, 2023. The terms is you can exercise on December 8, 2022, March 8, 2023, June 8, 2023, September 8, 2023. 4 different dates I have given. 4 different dates I have given. These are actual prices on these 4 different dates. These are actual prices on these 4 different dates. Strike price is this. Please ask your question. Do you want to buy at this when the price is so much? If you say yes, payoff will be there. If you say no, payoff will not be there. It depends. One term is very clear. For example, in this you excise here, no? You may say that's all. No more this contract. No more this contract. Once excise, the contract is over. Once excise, the contract is over, or multiple times excise can happen. If once exercise contract is over, then I may decide that I don't want to exercise here also, because I want to exercise it later. That is the terms of the agreement. Whatever is the terms of the agreement. But basic thing is very simple here. What here you are trying to do here is you are giving him flexibility of multiple dates plus multiple time exercise also. Multiple time exercise or one time exercise, that depends on the terms of the agreement. So it is very simple kind of an option. If you are giving only one time chance, if you are giving one time chance, the premium ideally will be between the American option premium and an European option premium. European option will be having lower premium. American will have higher premium. Somewhere in between is going to be the premium here. Any doubts on this? Clear? It is like a plain vanilla option, exactly like a plain vanilla option, just that I give you more flexibility on the dates front. American option was also giving that, but American option unlimited flexibility. It has unlimited flexibility. Here I put specific dates. Okay, Asian option. Now, Asian option is exactly like a plain vanilla option. Only thing is, on the last day I keep asking you a question, or do you want to buy at 3,400 when the price in the market? That price in the market is not last date price. That price in the market should be the average price for one full year. Take the average price for one full year, because on the last day, if market was bad or market is good, I may get impacted. So they're saying, let's not take the last day price, let's take the average price. So the question is, do you want to buy at 3,400 when the average price over the last 1 year is 3286? When the average price over the last 1 year is 3286, if you say yes, it will get exercise. If you say no, it will get lapse. Exactly a plain vanilla option. Only thing is, you should not compare with 3441. You should compare this with 3286. You have to compare this with 3286. 3286, I don't want to exercise the call option. Put option, I want to exercise it. Put option, I want to exercise it. When to exercise, all those decisions remain same. So here, what we do in an Asian option is, where the payoff is determined by the average of the price, where it is determined by the average of the price. Spread option, difference between the prices of the two underlying assets. You are going to look at the difference in the prices of the two underlying asset, and your compound I'll discuss. Bermuda option basically gives you the option to exercise at few specific date. Now what is compound option is, I bought a call option today. I bought a call option today. After, let's assume the life is 1 year. After maybe 3 or 6 months, after 3 or 6 months, you will be given an option. You will be given an option to buy another call option. You will be given an option to buy another call option, provided certain conditions get satisfied. It will be on the terms of the agreement. That is, you bought a call option today. I will give you an option to buy another call option, or I'll give you a decision to buy another put option. Your choice. It depends on the terms of the agreement. How does it work? Let's see an example. You'll understand it better. Strike price of the original option is 100. Let's take the example is 100. Strike price of call on call option. What is call on call option is, you can buy another call option. You can buy another call option which is rupees 10, which is rupees 10. That is, you bought a call option today with a strike price of 100. What is the premium you paid? I don't know. Let's assume the premium is 8 rupees. The premium is 8 rupees. This premium will keep going up, keep going down in the market. 8 will go up, 8 will go down. Now, assuming this premium of 8 has gone up to 20 rupees, has gone up to 20 rupees in the market. After 3 months, I have a flexibility to buy this 20 rupee option by paying 10 rupees. By paying 10 rupees. Strike price of call on call option. Strike price of call on call option. I can decide to buy another call option by just paying 10 rupees. By just paying, today I paid 8 rupees. Today I paid 8 rupees. I have a flexibility to buy another call option by paying 10 rupees. When will I pay? If the premiums in the market is going up beyond 10. So, price on the date of expiry is 120. Exercise option 1 and earn 20 rupees. This is your option 1 part, which is your normal option, which is your normal option. You have exercised it and earned 20 rupees. Exercise call on call option. Exercise call on call option. Buy the option 1 by paying 10 rupees. That is, you're exercising your call on call option, paying 10 rupees, getting that option and immediately exercising it and earning 20 rupees. Immediately exercising it and earning 20 rupees. So what is happening here is, there is a base call option which had a value of 20 rupees. You exercise it. That is okay. Another option, the same call option, you can pay 10 rupees, buy that call option from somebody else. That is, you is taking his call option, and now you're exercising this option also and getting 20 rupees on that. Getting 20 rupees on that. So basically, this action, no, that call on call option, when do you want to buy? That depends on the terms. It could be an in between time. It could be the last time also. It could be the end time. Basically, I will exercise that call on call. I'll exercise that call on call if I'm likely to get more than 10 rupees. If I'm likely to get more than 10 rupees. If it's 90, option 1 will lapse. I don't want to exercise option 1. Option 2 also I don't want to exercise. What is option 2 is, buying a call option by paying 10 rupees. Buying a call option by paying 10 rupees. Why will I pay 10 rupees, buy the call option and make it worthless? Because the call option is anyway a worthless option. So it basically gives you more flexibility. It gives you more flexibility to buy. Basically, if its call is good on the last day, if the call option is good on the last day, you will use that second option which you got, call on call option, buy the call option, immediately exercise. So here 20 rupees on the first option, 20 rupees on the second option, and pay only 10 rupees. Pay only 10 rupees. So you're indirectly earning 30 rupees. You're indirectly earning 30 rupees. It can be call on call, it can be call on put, it can be put on put, it can be put on call. Depends on the terms of the agreement. Understand that this is a product. This is call on call option is a product. In the practical world, option premiums keeps going up, keep going down. So I asked, do you want to buy a share at 10 rupees when the price in the market is so much? Like that, I'll ask you, do you want to buy a call on call option when the price in the market is 25 rupees and your exercise price is 10 rupees? If you say yes, please buy it. If you say no, please don't buy it. Call on call is like a share. It's like a share. So do you want to buy that option or not? You have to see. So compound option gives you that extra flexibility. Option on option. Option on option. Buy another option at specific price on the expiry of first maturity date. Depends on the terms of the agreement. All these are over the counter product. I'll just quickly summarize it. There are 8 different types of option. Chooser option gives you a flexibility to decide whether it is a call option or a put option. Compound option gives you a flexibility to buy another call option, another put option, write another call option, write another put option. Depends on the terms of the agreement. Barrier option is a normal plain vanilla option, but it will get exercise only when the barrier price is touched. Binary option, it's either all or nothing approach. All or nothing approach. Either I'll pay you 1,000 rupees or I'll pay you zero. Asian option, here you have to compare the payoff with the average price of the underlying asset and not the closing price. Bermuda option is between American option and an European option, where what you are going to do is on the those specific dates you can do multiple exercise or one time exercise. Basket option is basically it comprises of so many shares and I'm trying to buy one call option or put option for hedging. Spread option is difference between the value of two shares, two underlying asset. It could be difference between anything. It could be a difference between a bond and a share also. Whatever it is, two underlying gold, silver, copper, gold, anything, whatever is logical, you want to find the difference and then exercise it or lapse it. Any doubts on this? Okay, let's take a break and then continue.